everyone once again to the Wealth Builders
Mhm.
Masterclass. So this class, I think I'm really excited about that because our topic for today is building long-term wealth in this changing real estate market.
Mhm.
So over the last few years, we all have seen that, we have moved away from easy money environment into a much tighter capital
Mhm.
market. And today, investors are dealing with fluctuating rates. And I just heard that interest is going to go up again, to
Mhm.
manage the inflation. And then we are in this uncertain market, where
Yeah.
the inflation is all-time high. I think it's around 4% now. And correct me, Brian, if I'm wrong.
Mhm.
And then it's a really, really tighter capital markets. And the level of uncertainty,
Mhm.
is causing everybody to pause. And we are all are asking the same questions, is real estate still a good investment?
Yeah.
Is multifamily still attractive? Should we wait on the sidelines? Or
Mhm.
how do I identify the opportunities in this market? And perhaps most importantly, how do I continue building wealth? Because people are losing money too. A lot of
Yeah.
people are losing their shirts even.
Mhm.
And I did lose money on a couple of my deals too,
Yeah.
which I'm not too happy about. So when I was talking to Brian, right, Brian, a couple of weeks
Mhm.
ago,
Yeah.
when we came up with this idea, let's do this master class together. So I'm super happy that you agreed. And here
Yeah.
we are today. So a little bit about Brian. He's a multifamily investor, operator, educator, and a mentor. And I think he also has a podcast.
Mhm.
Dairy, is it still the Dairy of
Yeah.
Apartment Investor or
Diary of an
something like that?
Apartment Investor. Yes.
Great.
Yes.
So I think what I most appreciate about Brian is he brings not just the operator perspective, but an educator perspective as well. And I think you do have some educational portal as well. Can you tell me a little bit about your portal name as well?
Yeah, it's called The Tribe of Titans. It's at thetribeoftitans.com, but I call it an educational community. It's subscription based. And I do bring on, one-on-one mentor clients as well. And that's where a lot of the education stuff is. But most people who get in there and start poking around say, wow, this is a really, really good deal for the price. But yeah, thetribeoftitans.com is where you find that.
Great. So, welcome, Brian, to the Wealth
Mhm.
Builders
Yeah.
Masterclass. Super excited to have you with me today. So, can you take 30
Mhm.
seconds to tell us about yourself? I know you told us
Yeah.
about your education portal.
Yeah. Well, I was born and raised in Salt Lake City. And it seemed like it was a really, really boring town when I was growing up, but it's grown significantly. When did what most people do, and that's you go to college hoping that that's gonna, set you up for life. Um, did a bachelor's and master's at, the University of Utah. I've got probably like eight, red shirts with a Utah logo on it. But um, at the time, I loved teaching and I wanted to be a college professor. So I started a PhD and I started in August of 2001. And a couple of weeks after I started the PhD program was September 11th. And I bring that up because that was a big change in my life. I ended up deciding to go active duty. Spent 20 years in the Marines. So wasn't originally planned. It was a kind of a September 12th decision. But along the way, I started, buying houses, and my plan at the time was, we'll buy a house and we'll turn it into a rental when we have to move. And so I did that a couple of times. Um, Kind of got saw the benefits of owning real estate. And incidentally, my very first single family home purchase was right before the 2007, 8, 9 crash, the great financial crisis. So, I had one home, one rental going through that entire process. But um, 2018 is when I decided that I really wanted to focus on multifamily. I think that one of the real pivotal spots was getting into a coaching program around other people who were doing it, which is why communities, like mine are important. I mean, there's lots of them out there, but
That's true.
Yeah, I mean, it's just being around other people who want to do the same thing kind of makes it a lot easier for you to hit your goals as well. But
I agree.
yeah, I started buying multifamily in 2019, and I've bought at least one property every year since. Total of 23 is what I've done since, and unit
Wow.
counts 1500-ish. I think I stopped counting. So,
That's good.
Mhm.
Congratulations. Super happy. So
Yeah.
before we dig into our today's topic, so let's do a small little disclaimer. So this session is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. And if you have any questions related to any legal, investment related or anything, please reach out to your attorneys, your financial advisors, because we are not the financial advisors. This is strictly an educational masterclass or webinar. So some housekeeping items. This session is Q&A mostly. We
Hmm.
do not have any presentations. We're going to go through different questions that come to our minds, because everybody is thinking the same questions. Like Brian mentioned already, that we build communities and we like to strive within communities. So when we go meet people in the networking sessions, one-on-one at the events, everybody has the same questions today.
Hmm.
So it's always a good idea to, kind of mastermind or explore each other's mind, see what's going on. And there might be some answer there that resonate with any of us. And then, but the thing is, we're going to see that answer with our own lens or set of glasses, because everybody has a different experience. And that might be applicable to us in a different way.
Yeah.
So that's what we're trying to do over here. So please use the Q&A box for any questions throughout. Do not hold yourself. And if you put it in the chat, that's fine too. But chat sometimes get really chatty and we miss the questions. And in case we miss any questions, please send an email to winky@loombainvest.com. And I promise I'll get you the answers. So with that being taken care of, let's get started, Brian. So I'm going to
Perfect.
start with let's start, I think, really maybe at the base level, you call it, or the high level. When you look
Yeah.
at it, today's market
Hmm.
compared to where we were like three
Yeah.
years ago, 4 years ago, 10 years ago, market was really good, right?
Yeah.
So what do you believe has fundamentally changed that we as investors need to understand?
Markets are cyclical, and I think every time we get into the stage where, the market's going up, and if you look at like multifamily prices between, 2010 and 2020, they were very steady, very predictable, and it was like almost a straight line on this is how fast values are going up. And, when that's happening, it's really easy to make money, right? I mean, you buy something, you hold it for a little while, and you sell it, and you're going to make money on that. And that's what a lot of people were doing. And then COVID happened. Everybody remembers that, and the government pushed a bunch of money into the market. And that basically, lit investments on fire. And it wasn't just multifamily. It was pretty much everything. I mean, Bitcoin went up like a crazy amount. The stock market did extremely well over that period. But with a lot more money, people were taking that money and looking for investments. And it's a supply and demand problem right here. There's a lot of money floating around, and not a lot of investments. Therefore, investment prices are going up. And so from 2020 to 2022, instead of a straight line, it went crazy. It went bonkers. But you know we sold a property that in 22 that we bought in 2020. I posted about this on LinkedIn the other day. We had a tough time operating it. We bought it at like 90% occupancy. We sold it at 70, and we almost doubled our money. That's how crazy the market was at the time. It's just like it just kind of defied logic. And then the Fed did what the Fed's supposed to do. They're supposed, the inflation came along, and I'm telling everybody, most people know this, but the Fed raised rates, and when you look at the federal funds rate, that's the federal government's tool to control inflation. All right, so. And we hadn't seen the federal funds rate at the level. It went from, effective zero federal funds rate to 5.25, 5.5. And we hadn't seen rates that high since around 2000, beginning of the century. And that reset a lot of things. When we talk about the cyclical nature, you know, like this, then a peak, and that's like the classic cycle is you get really steady growth, then you get some really crazy growth, and then prices fall. And so, we're in that prices falling phase still. And I think there's two real things that caused that. Number one was the interest rates going up.
Mm-hmm.
With the federal funds rate going from 0 to 5, that changes a lot of things. And there was
Mm-hmm.
a lot of short-term bridge loans were the first ones to get hit, and a lot of those went belly up, and a lot of people lost money on those. Um, but then we had a wave of supply hit, and
Mm-hmm.
that affected rents everywhere. And usually, you don't see rents go down either. So 2024, 2025, a huge wave of brand new apartments, open their doors, and consequently rents in most major cities go down. And when you look at how properties are evaluated, they're evaluated by their income. And if rents are going down, we saw rents go down and we saw our concessions go up. I think we at our downtown Salt Lake City property, our rents over 3 years went down about 15%. And that also affects prices. So, you know, looking over the last couple of years, since the Fed, not the federal government, since the Fed started raising rates, rates went up, values kind of went down, and they plateaued a little bit. And then when this wave of supply hit and the Iran war kicked off and rates went even higher, things went down a little bit low. Things kind of started going down again. So, it's it is cyclical. And when I look at the dynamics and I look at what's happening, it has to bounce back. It has to bounce back. We are providing housing for people. Housing's always going to be in demand, and people are always going to pay for housing. And so when you start looking at, multifamily as an investment, the question is not if, the question is when. You know, our price is going to be depressed for another year? Have we hit the bottom and we're starting to come back up? That's really kind of the question. It's not whether it's going to come back up, is when is it going to come back up?
That's true. And I agree with you. There's never an equilibrium. It's like
Mhm.
economics 101, basically,
Yeah,
supply and demand,
yeah,
because supply and demand, I think there will be very short-term equilibrium that you see in the
mhm.
market.
Yeah,
After that, it's going to go down or go up.
yeah,
And I think when the investors are waiting, they're just waiting on the sidelines. They're looking for that balance, that equilibrium.
yeah,
And that, I mean, that happens, but it's a very short window to catch it.
yeah,
Because sometimes you just feel like waiting, oh my God, let me wait a little bit more, and you miss that window.
yeah,
And again, it could be upward turn or downward turn. So let me ask you this question,
yeah.
if you said you already had a property in
Hmm.
2020 that you bought. I think I went through the similar
Yeah.
experience. During that time, we sold our property in 11 months and we did more than double the money
Hmm.
and plus more than 100% bonus depreciation. That was like
Yep.
the crazy times. So I'm going to ask you that. So if you were sitting in 2020 or even early 2021 as well
Hmm.
versus today.
Yeah.
So, if you have to, get into again buying something or start a new project in multifamily, what would be the difference between now and then, how would you have evaluated the property then? And what
Hmm.
would you do differently now to make it still work in this environment?
Yeah, in hindsight, I wouldn't have bought anything in 2021 or 2022. If I knew what I knew now, I would have sold everything and, spent a lot of time on the beach somewhere, right? But, we don't have, we don't have a crystal ball. We don't have the benefit of hindsight. But um, before the interest rate started going up, I didn't have a single bridge loan. So what we were always doing, we were always getting 5 or 7 year loan terms. And so, we bought one property in 2020, two properties in 2021. Both of them had 5 year loans, and we still own one of them. And at the time, we were thinking, okay, 5 year term, and the writing was on the wall, but it wasn't very clear. Late 2021, inflation was, high single digits. We knew that the Fed was going to react. We just didn't know that they were going to react like they did. Okay. Um, there was a lot of misinformation out there. I mean, Jay Powell, hey, inflation's transitory. Was it? I don't think he was intentionally misleading anybody. He just, he was wrong, right? But inflation's transitory. We don't need to do anything. So the Fed reacted a little bit too late. But, late 2021, early 2022, most people were predicting interest rates would go, like the federal funds rate would go from 0 to 2 or 2.5. And even the Fed board was predicting those numbers, right? And um, they blew through 2, they blew through 3, they blew through 4, they hit 5, and 5.5 is where they stopped. And so what we were looking at back then is, okay, this is going to be a speed bump. All right. And I don't think very many people were anticipating what happened, and the people who were anticipating, a lot of people were just like, you know, um, I remember somebody making the comment about somebody who was, predicting that. He said, "Yeah, that guy's predicted 12 of the last three recessions." The people who were always predicting doom and gloom were the ones that were predicting doom and gloom, right? So, looking at that, we thought we were safe with 5 year loans. Now, one of the properties we bought in 2021, we sold in 2023, and we still made money. Um, I think we like barely hit our projected returns. But that was a combination of, a couple of things. We were able to, we had a 5 year loan. We were 2 years into it that the new buyer assumed our loan, right? It was a value add, and we did a lot. We bought it at a really good price, and we put a lot of value into it. So, in that case, we were able to win. The other one, 5 year loan, we decided to hold, and right now, I've got a broker looking at it tomorrow to give me a broker opinion of value, and our loan's coming due at the end of well, our interest rate resets. Our loan does not come due on this one, but, you know, 5 year loan right now, we probably can't sell it for what we bought it for, right? And so it's going to end up being a loss. So when you go back to that question, what would it have taken in 2021 to make money? Um, it would have been a very, very conservative purchase, right? You'd have to come in with, very low leverage with a long hold period, right? Um, so if you were buying something at 50% leverage or 50% loan to value, with a lot of cash flow, holding for 10 years, that type of property you're going to make money on, um, and that it turns out that that's the type of property that you always make money on. Um, you know, so there's a lot of, you know, the 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 flip side to those properties is if you compare, buying a property with 50% down to buying a property with 25% down, yeah, you always make money on that 50% down, but if you compare the numbers, you're getting high single digit returns over the life of the product, right? So, it is a risk reward, and I think a lot of people underestimated the risk there. And so, yeah, what would it have taken? We thought 5 year terms were safe. Turns out that not quite. And yeah, we have a couple of properties we're selling this year that are on 5 year notes that even right now, 5 years later, we can't sell for what we bought them for. And that's a product of the market. And unfortunately, yeah, it's just we don't my crystal ball wasn't working, back then. So, but yeah, that's kind of, had I a do-over, knowing what I know now, I wouldn't have bought anything. But, it always goes back to what's the safest way to invest in real estate. This is a master class about long-term wealth building, and I think the key is long term. You have to invest for long term to guarantee that you're not going to lose.
That's true. And I think that long term is like kind of a question too,
Yeah.
like how long? Because I get that from my investors. When I
Hmm.
say, be patient, it's kind of long term. It's like, how long? We've been waiting
Yeah.
because we wanted to sit on our properties, whatever we got so far. So, I think underwriting has shifted to a little bit since
Hmm.
you teach the class on underwriting too. So let me ask you a basic question. So,
Hmm.
if we just break down the basics of the underwriting, can you
Hmm.
tell us, like in real plain English, what is the point of underwriting a property? Without
Yeah.
polishing any numbers. That's what I'm talking about. The bare
Yeah.
basics, like we teach in our classes, in
Hmm.
our, like you teach at university, I teach at university,
Yeah.
like, from that fundamental perspective, not like that, thinking when most people underwrite, they think, I
Hmm.
can do this, I can do that. And then it's all the polished numbers.
Yeah.
So tell us the unpolished version of underwriting.
Yeah.
So how would we or how should we underwrite or how should we look at the properties in this environment?
With underwriting, there's a couple of things you're trying to figure out. Okay, number one is what is the property's value right now?
Mhm,
Okay, and I think that's the first thing is what is the property's value right now? And then the next thing you want to do, and this is where that part is not very difficult, right? You look at the income, you look at the expenses, you look at the market cap rate. You figure out what the net operating income is, you divide it by the cap rate, and you're going to get, pretty close to what that property is worth right now. Okay. Um, but the second part of the underwriting, and this is the hard part, is trying to predict the future, right? And
mhm.
that's really what it comes down to. Is you're looking at the data that you have right now. And so, for example, some of the data that I look at is what properties are coming online right now.
Mhm,
We look at the forecast for deliveries for multifamily. And if we're going to have a whole lot of deliveries, rent growth is going to be lower. And if there's very few deliveries, we're going to have higher rent growth. And we're also looking at demographics like population. If the population is going up at a certain rate, you need a certain amount of housing to accommodate that. So we're looking at kind of like the general housing market in an area. And there's a lot of these big think tanks that are also looking at that are making predictions on we think rents are going to grow this much, we think rents are going to grow that much. And so and it turns out that there's a wide range between what some of these different think tanks are publishing. So but when we're underwriting, we have to kind of make a call on where we think rents are going to go because that's going to determine largely how well a property is going to do over time. All right. Um, we bought properties. So 2022, the Fed funds rate started going up. Rents
mhm,
still we're going up. 2023 rents were still going up.
mhm.
2024 is when the supply wave hit and rents started going down. And I can say the same thing. Had I known in 2023 that rents would go down in 2024 and 2025, I wouldn't have bought anything, right? So that's just like the position you don't want to be in. So when we're underwriting, we have to make guesses on what the market is going to do with our income and what the market's going to do with our expenses, and it's kind of hard, like the expenses, um, there's things that are certain areas like the utilities, in Utah. our sewage bill goes up by a little bit every year, and it's quite predictable. You look over the last 10 years and, it goes up by that much, with a little range almost every year. So there's some expenses that are predictable. There's others that are a little less predictable, but you try to you try to do your the best best with the information that you have to kind of predict where things are going. And the other thing is you have to pick a sales date, when you're doing your underwriting. And it's the same thing. It's a little bit of where do I think the market's going to be 5, 7, or 10 years from now? Um, so yeah, it's a very imprecise, one thing I know for sure when I underwrite is that every number on my spreadsheet is going to be wrong, and that's kind of a reality when you underwrite, and it's just a matter of how confident are you that the market's going to go up, and that's reflected in your underwriting. People who were not confident that the market was going to go up in 2020, 2021, their underwriting reflected it, and consequently they didn't buy properties, right? And so, um, anyway, as far as the underwriting goes, there's parts of it that are easy to do. That's like, okay, what's the approximate value today? But when you start looking at, the future growth, properties don't always trade for what the value is today. All right. And that's something that I learned really, really quickly. Like you look at the T12, the NOI, you divide it by the cap rate, and it's like, wait a sec, why is this, why are people bidding a lot more than this? Or in markets where things are going down, why are people bidding a lot less than this? It's because when you look at the overall trajectory of where the property's going, if you're predicting, double-digit rent growth and double-digit price growth over the next couple of years, you can afford to overpay. All right. And if you're right, you get rewarded for overpaying. And I think people who bought in 2020 and sold in 2022 were rewarded for overpaying. However, anyway, if all the signs are that the market's going down and rents are going down and values are going down and rates are going up, now when you start looking forward, people get a lot more conservative on pricing, and it might not, the numbers might say a property's worth 10 million, but you might not get any offers, anywhere close to that number. So anyway, yeah, underwriting is difficult is the
Tricky. It
answer.
is, yeah, it's
Yeah,
tricky and it's difficult. And I think I agree on that. I think it's just like you were saying, speculating or predicting
yeah,
the future. It's very hard to predict anything. You only thing that you have in your hand is the present state. And I
yeah,
think if the deal is making sense at present, take the
mhm,
unpolished numbers. If it's positive cash flowing, a little bit, even a little bit,
yeah,
it makes sense to get into that. If it's negative, I think I will stay away from that. Tell you the truth, no matter how much I can predict the future, because nobody knows the future,
yeah, yeah, and
right?
that's that's
That's what
that's the
happens. It's like buying options, I think, in stock market, right? You're
mhm,
predicting, and then a lot of times people fail and they lose their shirt.
yeah,
And that's what happens in real estate too, because when you're polishing numbers too much, you do not know
mhm,
which way is going to land in the future or what's going to
yeah,
look like, because you're speculating. And it's not just you, even the sellers,
mhm,
nobody
yeah,
wants to sell whatever the present value is. They are just kind of predicting, oh, what would it look like 3 years from now?
mhm,
Why should
yeah,
you make that much money? I want portion of that too. So you
yeah,
have to look at all those assumptions as well, right?
yeah. Yeah, and it is there are textbooks on how to underwrite and how to be conservative, but the reality is most of the textbooks are going to say your exit cap. When you look at the cap rate when you plan on selling the property, that's going to determine the valuation. Most people are saying, hey, if we add 10 basis points per year, that's going to give us a reasonable,
Yeah.
that's going to be pretty reasonable.
Mhm.
Um, we bought a property in 2023 at a 5 cap, which is where market cap rates were at the time. And, right now, market cap rates in Salt Lake City are about 5.6 to 5.8, right? And so,
Mhm.
if we were selling that same property right now and using that 10 basis point per year, well, it's gone up 20 to 25 basis points a year, and that drastically affects values. And so,
Mhm.
even if you're doing what the textbook says is conservative, when there are big swings in the market, that conservative underwriting gets blown out of the water in a bad way, right?
That's true. Hmm.
So, I mean, when you look at there's always risk when there's a lot more market risk when you're looking at short-term investments. If you step back, and look at real estate over 10-year periods or 20-year periods, there is a consistent upward trend, and so when we start looking at wealth building, um, there's a lot of people that are seeking like the big IRRs, and that's fine. A lot of times that works, but I think the best way to do it is, diversify, really. When you
True.
start looking at investing,
Mhm.
um, I can buy a property right now, put a 20-year note on it, and say, I guarantee you're going to make money on this 20 years from now, and be pretty confident with that. But your returns are going to be, a lot lower than the 2-year value add that may or may not work. So, I mean, I think there's good reasons to invest in some of these short-term deals, and there's good reasons to invest in some of these longer ones. So, yeah.
Mhm. Yeah, I agree. And I think a lot of people are investors, they're waiting for the interest rates to come down.
Hmm.
And I think they're sitting in the sidelines and they think we haven't hit the rock bottom yet. Maybe it will happen
Yeah.
someday. It will be a perfect market. Interest rates will come down. Do you believe these investors are focusing too much on the interest rates and not enough on something else? There might be something else beside that.
Yeah. Well, there's not one single thing that's going to dictate, whether you make money or not, right? I mean, interest rates are going to influence it. Okay. So, I mean, when interest rates are higher, as a buyer, I look at, how much money am I going to make off this property? Okay.
Mhm.
And it might sound selfish, but why else are you doing it? We're buying properties to make money. So I look at a property and
Mhm.
I ask myself the question, how much am I going to make off this? How much are the investors going to make on this property? And the higher interest rates are, the higher my debt expense is. And my debt expense is going to be the single largest expense we pay on the property. And so, yes, when interest rates are higher, buyers are going to make lower offers because they have to make money. Now, you said something earlier about the equilibrium between supply and
Mhm.
demand. There's also kind of like the equilibrium with interest rates. If interest rates
Mhm.
go up X percent, and they stay there, what's going to happen with multifamily prices is they're going to go down, down, down until they find that equilibrium point, and then the prices are going to stabilize. But um, unfortunately, there's a lot of different dynamics in there. Interest rates affect values. The supply and demand affect values, and it ends up being if you guys remember like your high school physics class where you draw a little circle and it's like, what are all the forces on the circle? You've got three forces pulling down and two forces pulling up. That's really what
Mhm.
it's more like, is where you have a lot of different factors acting. Interest rates are one of those. But if we wait long enough, you know, the market will settle around that interest rate baseline. Um,
That's true.
and then the other factors are going to be more important. So, it is. I don't think they're necessarily wrong for waiting for rates to come down. There will be a time where if rates stay where they're at right now, there will be a time where things come into equilibrium and everything's going to be go again anyway. So, but yeah, after rates go up rapidly, it's probably a good idea to wait at least for it to, hit that equilibrium point, if not start coming back down.
Do you think it will happen? The boom?
Real estate is cyclical. Most of the markets are cyclical, and I think we're going to get through this. I mean, honestly, right now, we're buying things. We're looking at properties right now that are equivalent to 2019, 2020 pricing in Salt Lake,
Mhm.
right? And so when
Mhm.
you start looking at you know, 2020, 2020 pricing, you know, at some point, um, you know, what that does to the market is people who own properties are going to be very reluctant to sell. All right.
Mhm.
You know, I mentioned earlier, I'm selling 5 properties this year. Okay. Why am I selling these 5 properties this year? Because I have to. All right. And there's no
Mhm.
other reason there. Right. We're selling 5 properties because we're coming to the end of the loan term and we can't refinance.
Mhm.
And, you know, if we get to the end of the loan term without paying the lender off, they're going to foreclose. So we can't refinance. And if we don't sell, we're going to get foreclosed on. So right now, I think the biggest sticky point in the market, the thing that's keeping things from going up, is nobody wants to sell because when you sell, that's when you realize the losses, right? You know, until you sell, you haven't made or lost money on that part, right? I mean, on there's paper values, but it doesn't. You're not. It's not realized until you sell. So when when people are forced to sell, when more and more people are forced to
Yeah, there's gonna
sell,
more supply in the market. So
yes,
when
and
there's more supply, the price is gonna go down. So I'm coming back to
yeah,
the economics 101, basically,
yeah,
you know. And that's what is that distress is all about. Like distress asset. It's not necessarily like something is broken. It's more like an operational distress because operators do not have enough dough to run the
mhm,
properties right to take it to the next
yeah,
level.
yeah. In
And they do
some
not
case,
have,
yeah.
yeah, sometimes it happens. Go ahead, please.
Yeah, sometimes it's operational distress. You know, sometimes you've run properties perfectly well. Like out of the 5 properties that we're selling this year, 3 of them are performing extremely well. You know, we've been 90+% occupancy the entire time we've owned the properties, you know, and no issues there. But you know, the market in this case is overwhelming the good operators by how fast it's moved. But yeah, I mean, when people start selling, I think that's going to be a trigger. You know, there's lots of deals. You know, if I can buy something in 2026 at 2020 prices, you know, yeah, all day, every day is what I'm thinking. But there's going to be a tipping point where the money starts spilling in. You know, and I think it's going to take maybe another year or so. The war in Iran didn't help. If it wasn't for, you know, the war in Iran right now, I think that slowed things down. I think that uncertainty got a lot of people back on the sidelines who are ready to start deploying capital, lenders especially. Um, but I mean, we've seen the 10-year Treasury go up. I hit 4.5 yesterday. Um, 10-year Treasury in January was like 3.6, 3.7. Don't quote me on that, but you know, the 10-year Treasury's gone up, you know, 3/4 of a point. And that's
Mhm.
you know, that does matter when you're looking at things. But will it come back up? The question is when. You know, like I said with interest rates, if we were just to freeze interest rates right now and keep them the exact same place for the next, you know, 2 to 3 years, eventually pricing would reflect that and start going back up. Um, so when we start looking at like all the factors that are playing, you know, interest rates are definitely one of them. Another thing, and this is something that I'm really curious how it plays out, is we had this supply wave hit in 24 and 25. Well, you know, when interest rates started going up in 22, a lot of developers pulled back. Okay, interest rates kept on going back up in 2023, and even more developers pulled back. It takes, you know, 3 to 5 years to go from start to finish on developments like this. And so what we're seeing is the opposite effect. You know, 2026, and I have really good data on Salt Lake City, and you know, most the rest of the nation is similar. But in Salt Lake City, 2026 for new deliveries is going to be right about average since 2000. Okay,
It's going
so 2027 is going to be a 10-year low. All right, 2028 is going to be a new 10-year low. And it's starting to look, 2029 is about as far as we can see clearly, and 2029 is going to be definitely below average. And so when you start looking at the supply and demand, people are still moving, population's still growing. So what effect is supply and demand going to have on it? You know, the supply and demand should push rents up and it should put prices up. So you got a bunch of competing factors out there. And, the question really is, which one's going to win out, and in a way, if you're buying long term, high interest rates right now might actually help you, right? Because if you can buy a property in 2026 for 2020 prices, if rates go up a little bit right now, yes, we are going to get into a loan at today's interest rates, but if we're buying for a 20-year period, we've got a really, really good basis. And if rates come down later, we can always refinance, right? So, um, yeah, so it is a little bit of a guessing game. I've guessed right before, I've guessed wrong before. Um, and overall, I think, the fundamentals are still the same. I think what happened is when real estate, when we got past that, when we got into that really boom phase, a lot of people lost track of the fundamentals. Um, anyway, that's kind of my random thoughts on the subject. But yeah,
But do you feel the market is a little bit strange at this time? Very, very uncertain because
yeah.
interest rates are going up, inflation is all-time high, stock market is still booming, people are still making money in stock market,
Mhm.
look at the gold price, it's like everything is just
Yeah.
like upward trend, but at the same time, people have money too. If the inflation is going up, so I'm just wondering, how all this is working. I think it's failing the basic economics for me, tell you the
Yeah,
truth.
there's a lot of things that are just kind of odd, and you can look at like SpaceX IPO as an
Hmm.
example, how high that number got to. You know,
Hmm.
I, if you look at what their future and evaluating businesses is similar to evaluating real estate. You look at their income stream. There is something similar to a cap rate, that you apply, and that should tell you what the value is. But you know. I couldn't make heads or tails on that valuation, but the stock market in general should reflect the economic growth, and I think the last couple years, it's kind of been disconnected from that. Some people would argue it's been disconnected for longer. Um,
Hmm.
and I don't know what's going to happen with that. You know, AI stocks or companies invested in AI are doing really, really well. I'm scratching my head and wondering, are we going to have like, we had dot-com
About,
bust,
yeah.
late 90s, early
Hmm.
2000s, I think it was 99, but
Hmm.
dot-com bust, are
Hmm.
we going to see an AI, we're seeing a kind of an AI boom right now, but, is that going to translate into an AI bust in a couple of years? I don't know the answer to that. I think you can say the same thing with stock market as real estate. If you're buying stocks today to sell them tomorrow, you know, you're going to have problems, but if you're buying stocks today to hold them for 20 years, it's safer. You're going to see, you're not likely to have losses, but you're not going to
Hmm.
have crazy gains. So, if I've learned anything from this, in the last couple of years is just, where my money is. It's okay. And I think it's perfectly fine to have some money in some of these high risk, high reward ventures. But if you really want to build wealth, most of your money has to be in boring assets.
That's
And
true.
that's just it's kind of like textbook. Put most of your money in boring assets, and then you can take, a small portion of your investable funds and put them in these things that might do extremely well over a short period. If they do, take your proceeds and put them back into boring assets, is kind of how I would look at it. But um, and then, also there's diversification. I talked earlier about diversification
Mhm.
inside real estate, but
Right.
um, what we've seen in the last couple of years, once again, if I was sitting in, let's see, first interest rate hike was March of 22. If I was, let's go back to 2021. I think that's where you asked the question. If I was sitting with
Uh-huh.
2021 with perfect foresight, I would have sold
Hmm.
everything I had before March of 2022, and I would park my money in the stock market for the next 6 years. And if I have perfect foresight right now, it's a lot different. But since we don't have that, I think the best way to do it is, you have to have, a diversified approach. And it's not just, buying the S&P 500 is not diversified.
Mhm,
Buying S&P 500 and NASDAQ, not diversified. I think you have to have alternate assets,
mhm.
real estate included, but, you know, goes back to the don't put all your eggs in a single basket philosophy. You need to spread your eggs around. Real estate, I think, is still going to be a valuable investment going forward. Um, but there's headwinds that um, we're still navigating those.
Yeah, I think I agree on that. I think it's not just real estate or any other sector where we're investing. I think we need to take a little bit holistic approach at this time. So we need to know everything, like kind of maybe bird's eye view. We need to know everything. So it's not like that you can just say, okay, real estate is good. I'm just going to focus in here. But I think other sectors are impacting, the real estate investing as well as real estate is impacting other sectors as well. So we need to be like a little bit more holistic and kind of have the overview of where the whole market is going before making any decisions. But at this time, I wanted to also ask
Yeah.
you, it comes to my mind, in your opinion, what do you think? What are the biggest mistakes investors are making at this time? It's like basically stopping them to
Yeah.
build long-term wealth.
Yeah, I think, and this is, it's kind of counterproductive. I have a lot of investors that say, um, my ideal investment period is over 10 years, and we did a deal where we told our investors, plan for a 10 to 20 year hold. And the overwhelming response from investors was, I don't want my money tied up for more than 5 years,
Hmm.
and that's counterproductive to building long-term wealth. If you want your money in and out of these investments in 5 years, I mean, the idea of long-term wealth, you got to focus on the long term. All right. And 5 years is not, is in the grand scheme of things, is not a long term for an investment. Right. So, um, insisting on, hey, some of the family off, we've talked with like a lot of family offices and, private equity shops, and um, they're kind of insisting on these 3 to 5 years, but what they're doing is they're stacking the deck to make sure that they're getting their returns back. They're making sure that they're lower, they're more senior in the capital stack than the other investors. But if you're coming in as just a regular investor in a syndication, um, you need to be thinking more long term, than just 5 years. Um, the 5 year holds are okay, but do you also have money that's sitting in something that's going to be, a 10 or a 20-year hold? Um, and so I would say that's kind of the biggest thing. And the people who are buying 5 year deals 5 years ago are losing their shirts right now. And when you start looking at it, if you're doing everything on 5 year holds and you come into another drawdown, um, you may have done extremely well over the 10 or 15 years where real estate was awesome. But when you come into that drawdown and you're insisting on 5 year holds and you have a 5 year, we've basically had 4.5 years of prices going down. Um, Guess what? The numbers don't work for you. So you could go from having millions to having thousands. If everything you're doing is a 5 year hold. So it's yeah, I think when you're investing, and I'm doing the same thing. We're looking at what are we buying right now. I like the value add properties, but if we're going to buy a value add property, we're going to raise the money to fix it and still put a 7 or a 10 year note on it. Um, so anyway, I think the mistake is, if you're looking for long-term growth, you need to think long-term and
Long
not
term.
and not
Hmm.
just say, 5 years is way too long. How about a three? Because that's, the shorter the investment term in real estate, especially, the more likely, the more risk there is.
I think it's anxiety around being illiquid because real estate is really, really a highly illiquid place to be, right? So when they don't have the liquidity, they just feel kind of a little bit anxious that they don't have access to their capital. And I know some groups, they say that why sell real estate, if you
Mhm.
buy it, you're just gonna hold it forever. I know some
Yeah.
groups, they never sell.
Yeah.
It's like, okay, we just refi every 5 years, take the money out, give it
Mhm.
back. And this is like, they have different model actually. So a 5 year is a different model, I think. And then in the last few years, when the market was really good, people just like this model, 3 to 5 years, because that goes just like this: 3 years, boom, we sell the property and we give the money back. But I think, like you said, in this kind of uncertain times, maybe the
Mhm.
long-term hold is a better option.
Yeah.
And then now people are chasing more like cash flow deals
Mhm.
versus acquisition deals. So in this market, can you talk about it, how to balance both?
Yeah.
And I think after that we have one question in the Q&A too. So after answering that, let's look at that question as well.
Yeah, with the balancing, on a single deal, it's really either or, and I do like the idea of periodic refinances. You've got to give yourself a long enough runway for it to work though. So the property that we purchased for a 20-year hold, we had a 10-year note on it. And we told our investors that we would refinance somewhere between that 5 and 10 year mark to give us, a good period to kind of evaluate, hey, when's the best time to refinance? With those long-term holds, I think that the most risk comes in, what type of debt are you getting? And then, what you don't want to do is back yourself into a corner and be in the point where we're in right now, and this is me speaking from recent experience. You don't want to back yourself into a corner and not be able to refinance, not be able to sell. That's going to kill the long-term deal. So yeah, when you're looking at kind of finding that balance, it's really hard with one property, and I would say the best way to find that balance is, still that diversification, so within real estate, I mean, let's say, if you got $1 million to invest, you might allocate, 200,000 to real estate or 300,000 to real estate. What I would suggest is with that 300,000, maybe you split it up into $300,000 chunks, and you get one deal that's, a little bit of a longer term, one that's kind of an intermediate term. But if you're trying to find the balance on a single deal, it's hard. But it goes back to don't put all your eggs in a single basket. Learn from some of the big operators, like the family offices. I mean, when you start looking at what they invest in, they have some very strict criteria on, this is how much we will allocate to any given deal. This is how much we will allocate to any given sector. This is how much we're going to, and they have their allocation plan. And they're if there's $10 million to invest, they're not going to invest more than, half a million into any single deal because, the more you have in one area, the more likely, the more risk there is. Of course, if you pick right, you win, but it all goes back to Warren Buffett's number one rule of investing: don't lose. And so, um, but yeah, as far as the balancing act, yes, cash flow deals in markets where it's easy to cash flow don't tend to appreciate, and deals in markets that appreciate, have thinner cash flow. And so there are some trade-offs. One is not necessarily better than the other. They have different risk profiles and different reward profiles. So, just like I said before, most of your money should be in boring stuff, right? And maybe you take 10 to 15% of your investable funds and you put that into stuff that's exciting that you might turn, $100,000 investment into 1 million, right? But anyway, does that make sense?
Yeah, it does make sense. And that's SpaceX actually,
Yeah.
but it came down today.
Yeah. Yeah,
It's
I
gonna
mean,
fluctuate a little bit before it starts going up, I think.
yeah, and man, actually. what would I have done back in 2001? I would have gotten a job at SpaceX, right? I mean, I
That's
would
what
have
I
worked at
think.
SpaceX for 5 years, and then, now I'd have, some options to sell the stock that I, got. But yeah, woulda, coulda, shoulda. So.
That's true. Look at the question in the Q&A. It's a long question, so I would like you to read it.
Okay. So I underwrote a deal that a seller wanted 25 million, but the buildings were 22, and our underwriting conservatively came to 20.5. All right, we offered 20.5, the seller wouldn't come down, and passed about 24 months ago. The sellers aren't multifamily operators, they want equity, blah, blah, blah. Property's still on the market. Um, okay. All right. Yeah, seller financing on a $25 million deal is probably not going to happen. All right. I mean, when you get into like the, north of $10 million deals, you usually have some complicated ownership structures that are going to make seller financing difficult. You can always ask, but it's probably not going to happen. All right. Why is the seller stubborn? Well, if they can afford to hold the property, they're
They
going
will.
to hold the property, right? And that's it. It's that the properties that I'm selling right now, we're selling at a loss. And the only reason we're accepting lower numbers is we have no alternative. Okay. So if the seller can continue to hold the property, that's what they're going to do. So, I mean, when you start looking at that, um, here's what I would do. I would move on, right? You put your offer in, they wouldn't accept it. Now it's been 24 months later. Now you might want to just keep tabs with the broker and just say, "Hey, broker, let me know when this price comes down, or let me know if there's some movement here." And we'll maybe put in another offer. Okay. But, you know, if you and the seller don't meet on prices, just move on and start looking at other properties and go from there. But oh, sorry. Would not come. So I saw 24M. I thought 24 months ago. I read that fast. That's 24. The seller would not come down past 24 million a month ago. Yeah. So yeah, move on. Right. If you can't pay 24 million, move on and keep tabs on it. So, um, yeah, if they get into a spot where they have to sell, and there's no offers at 24 million, there's no other option. They're going to have to come down on their price. And we're doing that on properties right now. It's like when we first like when if I have 12 months before my loan comes due and I have to sell, I can be stubborn. Okay. So I mean, let's say I'm the seller of this property and I want 25 million for it and I've got 12 months. Well, right now, I'm not going to accept a $20 million offer. Okay, 3 months from now, I'm probably not going to accept a $20 million offer. I might accept 23. All right. But if over that 12-month period, the closer I get to that end line, now I've got multiple offers in front of me. And if the highest offer, when I'm 4 or 5 months away from my end of my loan, if the highest offer is 20, guess what? I'm taking the 20, right? And so, really, really what it comes down to is just a waiting game. Put your offer in, um, call the broker every month or so, and hey, how's that going? Have there been more offers? Have the sellers come down a little bit? And I mean, if you don't get the deal, you don't get the deal, but keep looking for others.
That's true, I agree. And then if the seller has deeper pockets, like you said, they might want to hold on to it.
Yeah.
Or there could be other story too. If you flip side, look at the flip side, there
Mhm.
might be not much wiggle room. Who
Yeah.
knows? But the numbers, how the numbers are laid out or how polished they are.
Yeah.
It's the story what you've been told,
Yeah.
right? So that
Yeah.
story could be different story behind the curtain.
And brokers are not going to tell you the good brokers.
Mhm.
I mean, the good brokers want to get the highest price possible for the seller. All right. So they're not
They're
going to
making
tell you
money.
they're not going to tell you anything negative about the seller, right? They're going to be, most of the brokers are going to be vague. They're not going to tell you the whole story, okay? Because if they tell you the whole story, that's going to, potentially tank every offer. Okay, well, they want 25, let's see if we can get people up to 24. But yeah, eventually. if they have to sell, or if they're coming up on a point where they have to sell, eventually they're going to have to come down to what the offers are. And Vinky said there might not be wiggle room. I mean, they might have a loan at 24 million, right? And on some of for a lot of operators, the most important thing is not defaulting on a loan. Because if you default on a loan, you're going to have a hard time getting loans in the future, right? So there could be a lot of things going on here, but as far as what you can do, put your offer in, and um, if you don't meet it, move on. Find another
Yeah.
property.
And if you really like it, just keep the contact with the broker and then see which way it's gonna go. Maybe you'll get an opportunity in future sooner than later, because if it won't sell and if they really want to sell, maybe they'll come down. So before we move forward, I wanted to ask everyone, if you have any question, please use the Q&A box and ask your question. So another question, Brian, I've been thinking
Mhm.
lately actually a lot. You think this market could be a totally different set of players? Because what happened is, how this
Yeah.
question triggered was the other day I was talking to this family office lady. She's one of my good friends. And then I was like, what's happening in the market? It's kind of crazy. Things does not make sense, or not in my experience from the, historically
Yeah.
looking at it, how market goes, supply, demand, stock market goes up, real estate goes down, kind of vice versa kind of thing. But it's like kind of strange market.
Yeah.
And she's like, this market is for a different set of players because,
Mhm.
now is the time for this institutional investors or the family offices to kind of step in and correct the market. Because when the
Mhm.
market was good, everybody was making money. Whether you have experience or don't have experience, whether totally newbie, everybody was like, okay, I can make money. I'm proving myself. But now, she said the market got so messed up with all those efforts, so
Mhm.
now it's time for the bigger players to come to the market and make the correction. And I
Yeah.
kind of agree with that, because when I'm talking to all these institutional investors or family offices, everybody's looking for the distressed deals.
Mhm.
And distress could be anything. It's nothing to do with the
Yeah.
property. It could be just like simply, you can't afford to hold on. You have to
Yeah.
kind of let go. So many funds, these family offices are starting as well. Those are
Mhm.
just like focused on the distressed deals only. That's the focus. So you think, is that true that this market is not for everyone? And maybe you need to sit
Yeah.
back a little bit and watch for the market being corrected first, then you step in.
I think there's definitely going to be a little bit of a changing of the guard, right? There are certain operators that are going to be like, okay, I'm done with this, right? And they won't come back in. But there's also a lot of opportunity for new people to get in right now, right? I mean, um, there are a lot of distressed deals. There are a lot of deals, where owners can't hold on and they're selling for, 50% of what they purchased the
Mhm.
property for 5 years ago, right? There's a lot of deals out there that are in that situation. I think if you're new trying to get in, um, what you have to do is, figure out what it takes to buy. And I think the biggest mistake, so a couple thoughts on this one. The biggest mistake I think people make is they overestimate what they can actually purchase, and they chase
Mhm.
properties that they have, no business chasing, right? So if you're newer to the market, don't chase that $25 million deal. And I don't know if the person in there was anonymous, so I don't know if they were new or not. Um, but don't chase a $25 million deal if you're brand new to the market, right? Because, I'll tell you, one of the properties we sold where we have under contract to sell right now, the highest offer that we got was from a brand new buyer. And, we started asking questions to that brand new buyer about where the money's coming from, and they didn't have good answers. Okay. The second highest was from, a newer buyer that had been in a couple of deals. He was going to syndicate, but, we estimated it was going to take $6 million in equity to close on the deal. And this person had never raised 6 million before. All right. He said he was in one deal where they raised three. and he wasn't the lead sponsor. So when you start looking at that from the seller's perspective, I'm like, okay, so you've never actually put $6 million together to buy a deal. Well, I did 3 years ago when I bought that property, and I know what it takes, and I know that if you're not prepared, you're not going to get it. And so you got to realize that the people who own properties know what it takes to buy a property because they've done it before. And if you can't show people that you have what it takes to buy a property, you're not going to buy anything because they're going to look
Mhm.
at your offer and they're just going to, crumble it up, throw it away. Okay, we're somebody who's actually done this before, because we really want this deal to close. So, if for new people getting in, I think it's a great time for new people to get in, but they just have to do it, they have to do it smartly. They have to figure out the debt first, they have to figure out the equity first, and they have to right size the deal. And if that means your first deal's $2 million purchase instead of a $20 million purchase, hey, that's great. Keep on doing those $2 to $3 million deals, and eventually you'll do those 20s. So for new people, I think it's a great time for new people to get in. Just they've got to do it smartly. But yeah, it is definitely a changing of the guard. I think there's a lot of, like you said, a lot of institutional investors that are going to swoop in and buy. Now, institutional investors are only going to buy the larger properties, right? They're not gonna dive down into these 20 units, unless somebody will wrap up a big portfolio. If you've got 20 unit properties and you wrap it up into a 400 unit portfolio, institutions will buy them. So yeah, I think when you're looking at the top end distress, you're going to see a lot of institutional money coming in. They're going to buy a lot of distressed assets, and they're gonna have the contacts to be able to do that. Um, but yeah, where the space is for regular people is kind of in that sub 100 unit market, where there's distress and there's not institutional competition. So anyway.
So let's shift gear here a little bit.
Yeah.
So let me ask you this. What trends are you watching today that most investors aren't paying enough attention?
Yeah, I mean, I am paying attention to what the Fed's doing. A couple things that concern me is the national debt. That's one of those things that over time is going to, I think, erode the types of returns that we can get. It's not going to be something that just comes to a screeching halt, but it's going to um, slowly affect our economy negatively, right? So I think that's one thing. So we're looking that there's a couple things that we have to look at, spot checks. When we're making purchases, we have to look at rates right now. When you look at where the debt is, with that much national debt, um, there's going to come a breaking point if rates get too high. So there's kind of I don't know. I wish I had a crystal ball on that one. I don't know what I'm looking at things that were important last time, but the reality, I'm gonna talk from both sides of my mouth. The reality is, every time there's a downturn, it's largely caused by something slightly different. And every time we come out of a downturn, people try to, put measures in place to prevent the most recent downturn. So, um, but I don't know is the answer. We look at interest rates right now, and if deals work today at interest rates today, we'll buy them. We try to be as conservative as possible when we're purchasing properties, both with our debt and the equity. Um, but without a crystal ball, it's kind of hard to tell.
Actually, I talking about crystal ball, I was going to ask you that. What do you see
Yeah.
in your crystal ball for the
Yeah.
multifamily industry for the next 3 to 5 years? Because I think it has been on
Mhm.
all the options, right? We used to say that multifamily is the recession-resistant asset class.
Mhm.
So what do you see in your crystal ball now for 3 to 5 years, keeping that in mind?
Well, I mean, rents have gone down significantly in the last 2 years, and I this is I'm talking Salt Lake specifically. There are metros that rents have continued to go up over the time, but what I'm seeing in the market that I pay most attention to is, we are starting to see rents go up. We're adding about 3 to 5% on our renewals right now, and nobody's complaining. All right. A year ago, if we were keeping rents flat on renewals, residents would come in and say, "You're charging me X, but the brand new tenant is getting, $50 less on their rent." And so a year ago we were dropping rents on renewals, which usually doesn't happen. But yeah, right now on renewals we're moving 3 to 5%, and that's one of those indicators that tell me that this big wave of supply in Salt Lake City is getting close to that equilibrium point. Okay. Um, is it at equilibrium yet? Probably not, And then looking into the future, we've got three straight years of below average deliveries, and the population growth is not slowing down. And so, when I look in the next 3 years, I see rents going up. All right. And I see rents going up faster than average. And I think there's going to be a correction in the other direction, now that the
Mhm.
supply wave has come through. So I think we're going to see really solid rent growth for the next 5 years. Anything past that's just a guess. The big question is, what's happening with interest rates, and specifically with what we do. The loans that we get are based off of the treasuries, not the federal funds rate. So I'm looking more at that 10-year treasury. What direction's that 10-year treasury going to go? Um, if the 10-year treasury comes down from where it's at, things are going to be better faster. If the 10-year treasury largely stays where it's at for the next, 3 to 5 years, eventually, the pressure that interest rates put on prices is going to subside and things are going to start going up. But yeah, right now I think great buying opportunity because of the lower basis. We're going to have rent growth. Hopefully, we don't see the 10-year treasury keep climbing, climbing, and climbing.
But you think there's going to be impact of the all that technological shift that we are having as well, because it's not going to follow the historical path, what's been happening in the past, because we are living in a totally different era at this time.
Yeah, and I don't know. I'm not smart enough, to figure that one out. What I do know is there've been big shifts that come, right? So,
Mm.
I was looking at. I mean, I spent way too much time yesterday on a LinkedIn post about AI in schools, right?
Mhm.
And there've been big technological disruptors in the past,
Mhm.
right? So the internet was one, right? And everybody was saying the same thing about the internet. Hey, this is going to disrupt things, and we're in a new economy now. And then smartphones, hey, this is going to disrupt things. And um, what I think is going to happen is it's going to be very similar to the previous things that have come out. Um, with the internet, with the smartphones, with all that other stuff, I think it shortened the information curve a lot, which increases volatility in a lot of the markets. But once again, when you step back and look at things, over the long term, that kind of that smaller information gap is really going to smooth out over the long term. And I think that's what's going to happen. But I've been wrong before, and um,
I don't think it's
yeah,
about right or wrong. It's about, wherever we are at the
yeah,
present state, we can see only so much, whatever is in our
yeah,
experience.
exactly.
And whatever is not in our experience, we cannot predict
Yeah,
or we cannot even speculate. Because that's where we feel like we are wrong. We are not wrong.
yeah,
Whatever we know, we know. Whatever we don't know, we don't know.
yeah.
So
And
at
I,
this point, I'm sorry, go ahead.
I was going to say, yeah, I hope some of these people that are making money hand over fist in the AI fields are cashing out, and they're diversifying themselves, and they're throwing more money into
Mhm.
multifamily. That's my secret hope. People that made a lot of money. There's a lot of people that made a lot of money on the SpaceX IPO. I mean, SpaceX turned around and bought a AI company for 60 billion, and a lot of people are cashing out on that right now. But, bottom line, the better the economy does in general, the better real estate does. If the stock they're not 100% correlated, but the more money that's the stock market is spitting out, the more money people have to invest in other stuff, right? And so
True.
if you've seen your stock market portfolio, go up by double digits over a couple of years, a lot of people are taking money out of the stock market and putting it into other assets as well. So, um,
Yeah.
yeah.
So boiling down to diversification, that's the important thing. So I'm going to remind everyone, if you have any question, please use the Q&A and ask your question now. So one last question for you, Brian, if we don't get any question from the audience. If you could leave our audience
Mhm.
with one framework for making better decision in this uncertain market, what would that be?
It's all risk versus reward. All right. Understand the risks in every investment. Every investment's going to have risks. Understand the risks going in. Um, and, if you understand the risks going in and you think it's still a good investment, go ahead and do it. Right. But at the same time, I'm going to go back to what I said earlier, put most of your money in the boring stuff. Right.
Mhm.
I was hyper allocated to multifamily when this last crash happened. And if you're hyper allocated into one things, your numbers flip really fast. So, put a lot of money in boring stuff and put a lot of eggs in different baskets across everywhere else. But yeah, that's what I'd say.
Thanks, Brian. I really enjoyed today's conversation. Thanks for joining us. I think there's no questions or no more questions from the audience. Thanks for your insight, your perspective on the market and how you are doing things, how you're handling
Mhm.
your day-to-day, research on the market. And thank you everyone for joining us today for this class. And we all know markets will change, interest rates will change, cycles will change because we know that historically it's been happening. But the
Mhm.
principles of disciplined investing, thoughtful decision making, and long-term wealth creation remain consistent. So I hope you all enjoyed today's conversation. So it might have given you some clarity, some confidence, or some perspective. So please use that, and we'll see you in our next masterclass next week. And thanks again. And woohoo, I did it with my
Yeah.
bad voice or bad audio, made it through.
Yeah.
Thanks again. Any
Yep.
last words, Brian?
Somebody just threw a question in. Can you explain the boring stuff? Low risk investments. Okay.
That's true.
Yeah. I mean, S&P index fund I would call boring. It's a little bit more volatile, but make sure you have money in places where you're going to earn more than inflation, and it's very low risk. That's what I would say with the boring stuff.
Yeah, thanks again, everyone. And the recording should be out either tomorrow or early next week. And I'll see you guys next time. Thanks, everyone. Thanks, Brian.
Thanks, Minky.
Bye.